Stock investing for beginners, what you must know. So my first rule with investing in stocks is never invest more than you feel comfortable to lose. So basically with stocks, and same applies in the crypto market, it's a volatile market and you need to expect that there will be substantial rises and substantial drops. So you have to be in a position where you can basically, you've got a more than substantial cash flow and you're sitting on more than enough cash where any expenses that do come up or may come up mean you don't have to basically dig into what you've invested and really extract that out. They're really key things that I would be saying. And the reason for that is simple. So what happens if the market drops and let's say you lose your job? Well, you might be freaking out and you might be feeling like, oh, gee, I need to sell this at a loss. Whereas on the other hand, those people that are in that sort of strong financial position and they've only invested what they can afford to lose, well, they can really be looking at it as a situation where basically something that they value at a higher value is on sale. So they can buy up a good amount at a discounted price. So that's really the importance there with making sure that you can only invest what you can afford to lose. The next thing you need to be aware of is you need to think about, are you wanting to invest for growth? Are you looking to invest for cash flow? Or are you looking to invest for a combination of both growth and cash flow? So by deciding this outright, that can allow you to really determine, okay, what's a suitable business or ETF on the other hand, or what would be unsuitable based on my investing objectives. So for those who are not sure what to invest in and just want to get started, maybe you're time poor, or maybe you just don't want to learn about every business under the sun and then keep tracking them year on year to really see what they're up to, well, a good place for that, for those sort of people to invest in, I would say is probably ETFs. So the advantage with ETFs is you can really just hold on to them and it's a basket of a whole lot of stocks and it's really a diversified opportunity where really, I guess it minimizes risk firstly, and it just means you're really tracking the level of performance of the market. And the big advantage to doing this really is not only just the time-saving component, but you also don't need to trade in and out of anything in particular. It's all just done for you. So it's just a way where you can just sit back and your portfolio just automatically looks after itself, and it's just a completely passive way of investing. So you can very easily dollar cost average into ETFs. My personal, I guess, opinion with ETFs is I look for ones that have the very lowest management fees. So in particular, ones that have management fees of less than 0.1%. And the reason for this is simple. So if it's something I'm going to hold for a very long time, so my outlook might be 10 plus years, let's say, well, the higher the management fee, the more it's cutting into your profits or potential for growth. So given that, it's a suboptimal way to invest if you do have very high management fees. And that's why I really like looking at things that are, I guess, that just track market performance. So a few of my personal favorites. So in the US market, I like VTS and IVV. So for Australian investors, they're probably the best options and they have management fees of less than 0.05%. And it just really depends out of those. Do you want to track all of the US market or do you just want to track the top 500 US businesses? Another option that I like if you're looking for exposure outside the US is VEU. So this is an opportunity where really you can get a broad exposure excluding the best US stocks. And if you're looking for, let's say, Australian exposure, you could look at A200. So, and all of these have management fees of under 0.1%. So based on that, they're basically opportunities or ETFs that I would be certainly open to considering if I was in the market to buy some. So for those that wish to own individual stocks, my tip would be this. So you want to understand the business completely. So you want to know what they're doing now, what are their future plans. So maybe as an example, if you're an Apple fanboy or fangirl, you're across their ecosystem, you've got their phones, their tablets, their laptops, or maybe you're a big Tesla fan where maybe you've got one of their cars, maybe you're really excited about their future product plans that they're going to be delivering in future years. Well, they're the sort of examples where you might really know the product inside out, and then you can actually determine, well, is this a business I would actually invest in, or is this a business alternatively that I would ignore in favor of something else? So Or perhaps you work in a particular sector. So let's say the banking sector. So you might have particular knowledge where maybe you're aware that, okay, interest rates are going to be going up. This will improve bank profitability. And therefore you might be inclined to, I guess, put money into a particular banking stock if you think there's a particular one that represents really good value. Or maybe you're a crypto investor and you realize, hey, this particular bank is very pro-crypto and is very crypto friendly, so I might be more inclined to invest that way. So there's some of those kind of examples where you can really have that level of knowledge where you can really understand the business completely. So the important thing if you're going to be, I guess, an investor in particular individual stocks, well, you need to be really confident that that particular business will outperform the market, because that's what you're betting on if you're investing in a particular stock versus an ETF at the end of the day. So, and the reason for that, again, I need to reiterate, is if you're buying individual stocks and you're going to be trading in and out, well, there's fees to doing that. So really it's cutting into those, at the end of the day, profits that you would otherwise receive. So you need to have an incredibly high level of conviction in any stock picks that you're making, if indeed you're going to go that route. One piece of advice I often hear a lot of people saying is you need to diversify. Well, my personal opinion is that's an incorrect approach unless you're someone where you're already financially free. So depending, of course, on your financial objectives, if you really want to get from point A to point B in the quickest possible time and you've got some quite high level of ambition, well, the best way of really, I guess, making a lot of progress in the markets is going with your highest conviction play and actually concentrating your funds in a very small number of businesses. So for me personally, and this is just me, doesn't have to apply for you at home, but I wouldn't personally ever, as someone really trying to, I guess, grow my stack, to put it that way, well, I wouldn't personally be interested in investing in more than 5 particular businesses at a given time, or more than 3 ETFs at a particular time. So I would really be looking to concentrate those funds, and the reason for that is simple. So if my highest conviction play is going to grow more than my second highest conviction play, well, I want more money invested in that highest conviction play so as to maximize the amount of profit I get, whether growth or cash flow is my objective. So the next comment I'd have is don't fear dips. So it's a bit like if you go to the supermarket and let's say something you would be buying every week is 50% off this week. Well, if you're getting what you'd be buying already at a 50% discount, well, you wouldn't suddenly decide, oh, I'm not going to buy, and be afraid of buying all of a sudden. You're going to be happy to buy, and maybe you buy a little bit more because it's on sale. So whereas on the other hand, maybe you're looking at petrol prices at the moment. Well, if the prices have gone up from a particular price and they've almost doubled in recent weeks, well, you might be a bit more cautious with filling up and you might want to conserve a little bit more. And they might be the times you don't sort of necessarily lash out. Maybe you consider alternatives. Maybe you start riding the bike to save a bit of money, or maybe you catch public transport. So they're the sort of things that if you're responding that way in real life, well, they're the ways you really need to approach the market. And people in the market tend to be really fearful when it comes to prices, where if there's dips, people really fear the market and they get out. Whereas when prices really rise rapidly, well, that's when people are FOMOing in typically. So you really want to take that, I guess, real life approach to the scenario where if you're, again, able to buy a business for 50% of the price and you were happy with that price when it was 50% higher, well, now that you're getting it at a 50% discount, well, that's a meaningful buying opportunity, and an opportunity where if, say, you normally dollar cost average into a particular business or ETF, well, if you're getting it 50% off, well, you might be willing to perhaps invest a tiny bit more just to really, I guess, take advantage of that opportunity in front of you. Whereas if the market has gone absolutely crazy and you've got meme stocks that are going up by incredible amounts, well, they're the sort of situations where you might be perhaps not as inclined to invest, and maybe you ease off a little bit. Maybe if you're going to take profits, maybe that's the opportunity to take profits when those irrational kind of things are happening in the market that just don't make logical sense when you really break it down and look at it. And it's been the same story in crypto when you've got these multi-million-dollar JPEGs that are not even actually yours, really, I guess, going for so much, and then you've got all these meme coins, and you've got meme coins within the top 10 market cap. Well, they're the sort of scenarios that you look at where you think, okay, this is a ridiculous level of exuberance, and I might take some profits at this time and really lock in those profits. So then basically you've got a little bit of extra ammunition for when there is a meaningful market dip at the end of the day. So really, that's the way I would personally approach the market to maximize my investing results. And it's also important to recognize that even if the market is dipping dramatically, and whether the worst case scenarios around the world are happening or whatever the case may be, that make you think, okay, every business is going to go to zero. Well, even in declining markets, there are always businesses that will be profitable and businesses that in those particular scenarios will do really well. So it's like in the last couple of years, the businesses that have done particularly well have been those that really have, I guess, utilized really the online space broadly. So those that have really tapped into online resources and online opportunities, they're the ones that have absolutely boomed. Even in those sort of early stages where there was that sort of initial element of uncertainty and prices were dropping, well, those that have been the big winners have really been those that have really, I guess, tapped into those opportunities. So that's, I guess, the other approach that I'd have with stocks, where you don't have to be fully out even if the market is dipping and feels like it'll go to zero. There are always opportunities, but it's just a case of knowing what those opportunities are and looking, because they are there. And I thought I'd also touch upon the idea of time in the market versus timing the market. So I feel there is scope to do a bit of both, and you can read the situations, but nonetheless, I am a fan of, personally at least, sort of dollar cost averaging. So really, that just means continually investing over time and really just continuing to put in wherever, in my case, I believe that opportunity is greatest. So whether that's in stocks, whether that's in crypto, whether that's in a real estate related asset or opportunity. So there's all sorts of opportunities out there. So, but at the same time, I do have the opinion that when there is an irrational level of exuberance, that's the time where, again, as I've already gone through, I would be really comfortable taking a profit. And whereas when there's a scenario where there's, in market terms at least, blood on the streets, and there's really that opportunity to buy something for cents in the dollar, well, that's really when I'd be looking to invest a little bit more aggressively and really make sure I'm allocating a higher percentage of whatever it is that I'd be normally investing into investments to, I guess, capitalize and make best of that scenario. So perhaps if I've got a little bit of money sitting on the side, and perhaps that's probably something I personally need to do a little bit more of, but that's something where you can really, in those scenarios, take good advantage and make the most of the opportunity there. So absolutely dollar cost average away, keep investing in the market, but do look out for when there's silly signs of exuberance, because that's when you can really take your profits and really, I guess, lock in that, I guess, opportunity there to, I guess, bring back some cash, and then you can, I guess, make some other decisions with it to keep it on the side for future opportunities where there's big opportunities to buy. And for those wondering how to get started, so for Australian investors, you can really look at all of the 4 major banks. So to go through just 2 of the big ones, so you've got Commonwealth Bank, which has CommSec, and you've got NAB, which has NabTrade. So they're 2 of, I guess, the pretty solid, in my view at least, trading platforms in Australia. But there's many others, and you don't have to necessarily go with those that are related to banks. So there are other opportunities, and other opportunities where the trading fees are probably going to be quite a lot lower. So it just depends on, I guess, how much you trust, I guess, the reliability of their service, and how much you enjoy, I guess, all the, I guess, services that they do provide. So in that regard, do your own research, but they're just 2 opportunities certainly for Australians who want to start and want to know where they can actually go and buy some stocks. Thanks for watching, guys, and if you enjoyed this video, make sure you like, subscribe, and hit the notification bell for future updates. And if there's any particular stock videos you'd like, let me know in the comments section below. I'm happy to produce some more in the future. But over the coming weeks and months, I do have a few crypto videos planned. So if you're interested in crypto, make sure you tune in for those, because I'm seeing some upcoming opportunities in the market that I'm certainly interested in, and you may be interested at home in hearing about. So yeah, tune in for that. But anyway, guys, see you in the next video.